Afternoon once again for your participants and also the panelists. We are going to start our meeting. Our meeting is the Prudent Debt Management in the East African region and the SADC region. We are going to have a conversation. We have dubbed this dialogue a game of loans, because indeed it's a game, but it's also a very deadly game. Our program is going to run as follows. We are some 9 minutes late. I hope we catch up. We are going to start with welcome remarks. I'll give some welcome remarks and also give the house rules. And then we are going to have presentations from Leonard Wanyama and Jason Bragaza. These two experts undertook some research in Eastern and Southern Africa, and they will be making a presentation. I'll give them 20 minutes to make their presentations. Then we have a presentation from Miss Isabella Kapowischi. I hope I have pronounced it right. On the IMF perspective on the prudent debt management. And then we also have some input from Mr. Alvin Musioma, Julius Kapwepwe, and Julius Kapwepwe, and then we will have questions and answers. And I hope we'll have a very good discussion. So now I'm going to give a few opening remarks and set the stage for our discussion. And I also present our eminent resource persons, our eminent panelists. In the opening remarks, I just wanted to say that Eastern and Southern African region are facing a triple jeopardy. You know, as you are aware, the COVID pandemic brought on board a crisis, an economic and also a health crisis. So we are facing a health and economic crisis but also amidst an accumulation of debt. The region is having a very high debt levels, and the debt has emerged as a major threat to sustainable growth. Within the period of when the COVID pandemic started, both regions, the East African region and the SADC region, have accumulated a lot of debt, and some of the debt has even gone beyond 50 or 60% of our GDP. Yet, both regions, under their macroeconomic convergence criteria, had agreed that they want to go beyond 50% of GDP for the East African region and 60% of GDP for the Southern African region. But a number of countries have gone beyond that mark, which is affecting prospects of our economic growth. So the purpose of this conversation is to have a deep understanding of the current debt situation in East Africa and the SADC region. We also want to appreciate the current region economic outlook amidst all these challenges. And we hope at the end of this conversation would have generated some measures of how to prudently manage our debt. In order to help us in this conversation, we have an eminent list of panelists. Most of them don't need a lot of introduction. I will start with my friend, Mr. Alvin Mosioma, who is the founding executive director of Tax Justice Network Africa. TJNA is a Pan-African advocacy and research network, which is has membership of 16 African countries. He has a vast experience in working on tax justice and also on curbing IFFs from illicit financial flows from Africa. That's Alvin. It's so difficult to read out all because these are eminent people, so I'm just giving a synopsis of the expertise on the panel. The other panelist is Leonard Wanyama. Leonard Wanyama is currently the executive director of the East African Tax and Governance Network. He has a lot of experience in development, governance, and international relations in Africa, and he has a lot of experience. He was a lecturer in a number of universities in Nairobi. The other panelist is Jason. Jason, you are most welcome, and a special welcome to you, Jason, because you are coming back home. Jason Bragaza is a Kenyan economist with over 10 years experience working on international development in Africa. He has focused his work on trade, regional integration, finance for development, and tax, illicit financial flows, domestic resource mobilization, poverty, and inequality. And at the moment, he's the ED of AFRODAD. We are also very lucky that we have Isabella Kapowiski, the senior economist and resident representative of the IMF in Uganda. Thank you so much, Isabella, for taking time off to join us. Lastly, but not least, my brother from Uganda, who is now in Kenya, Nairobi, Julius Kapwepwe. Julius, at the moment, is the Deputy Executive Director of UDN. I grew up hearing UDN working on issues of debt. And in Uganda, UDN, those are the experts of debt, and they have been following up on this issue for such a long time. So he has the expertise in debt, in development aid policy, and he's a Pan-African with a hands-on experience in designing, analysis, and managing economic governance, public finance management policy, social justice programming, and advocacy. So I want to welcome all of our panelists and thank them so much for taking time off to be with us. And me, Jen Nalunga, I'm the Executive Director of SEATINI Uganda, who will be the moderator. Our conversation, we are going to, we have a chat box. If you have any comments, any suggestions, you can either put up your hand or you can write your comment or question in the chat box. We have somebody who will be following up on the chat box. Maybe what I also want to say is that this meeting has been organized by the East African Tax and Gender Network, by AFRODAD, Tax Justice Network Africa, and UDN. So thank you so much, our panelists. We are going to start our panelists with Mr. Leonard Wanyama, who is going to give the regional review burdens and economic sustainability, tax justice perspective to public debt in the East African region. Leonard, you have 10 minutes. 15. Okay, you have 15 minutes. Leonard, the floor is yours.
Thank you so much, Jane. As usual, normally I always say when you speak, there is always some good things that are coming our way. So when you just said East Africa Tax and Gender Network, I am sure we'll be producing some gender work coming soon. But just as a correction, for those who don't know, we are East African Tax and Governance Network. But it's a real pleasure. I think I'll share the presentation. Let me just work on it here one bit. So, as you all know, the East Africa Tax and Governance Network is a regional organization that brings together civil society and individuals who work on issues of taxation, but our mandate also extends to questions of governance. Now, this is because a lot of our members are not directly organizations that work on tax and have other issues in which we try to link and kind of contextualize how tax affects their work. And so after a strategy meeting on double taxation agreements in Nairobi, I think it was a year back, and a meeting in Burundi that was sponsored by SEATINI, in which we were trying to explain to our Burundian colleagues about taxation issues and how they are linking up to, for instance, questions of debt, we realized that we needed to come up with some publications or working papers of sort that help to explain this issue a bit better. And so we then came up with this study in order to try and create some understanding and linkages to these issues. Tentatively, we are calling it Regional Revenue Burdens and Economic Sustainability, Tax Justice Perspectives to Public Debt in East Africa. In this respect, we not only want to focus on the issues of the burdens that a lot of our members are examining, or a lot of the citizens and community-based groups are feeling at this point in time, but also kind of understanding how it relates to issues of economic sustainability, and then also bringing the tax justice perspective, because a lot of the times people they ask us this question, what do you mean by tax justice? Because there are a number of questions about what tax justice really means in that case. So in getting or presenting our issue about tax justice, the paper also kind of makes some definitions in order to kind of frame the question of what is a tax perspective in economic justice debates. So in this regard, there are always these issues of tax inequality. Any system has some form of inequality in it because of the various disparities that happen in whatever system, whether through the issues of productivity of labor and so forth. So there is that issue of inequality in systems across the world. But we then come in and say, what is beginning to emerge is that there is a system in which, in these inequalities, big business and wealthy individuals are managing to find ways of dodging their tax obligations. And in that respect, the tax burden primarily begins to shift more and more towards the poor. And so for us, when we talk of tax justice, these are the efforts to try and stop this emergent system of injustice that is coming across in our case, East Africa. So, of course, then we have to ask ourselves, what do we mean by debt? So we examined the questions of the definitions of what we mean by public debt or sovereign debt, where the country borrows from both local and external lenders to augment its revenue from taxation for purposes of financing public spending, or both domestic and external debt that constitute the government debt. So these are just the general definitions, understanding what domestic debt means. So funds raised through financial assets, and then external debt, where it is bilateral or multilateral or commercial sources. So the bilateral sources, which are government to government, and multilateral debt, which could be sourced from financial institutions. But then, of course, increasingly, there is the commercial sources which are coming about in relation to, for instance, the Eurobonds and so forth. So just understanding what is it we mean by debt. Now, what then is the context of debt? From our analysis, we are seeing that, and this is especially in East Africa, the developing country debt repayments have increased by 85% since 2010. The fiscal environment is one in which developing countries are increasingly weak, in an increasingly weak economic state. So when we look at IMF estimates, 40% of countries in the region are either debt distressed or at a high risk of it. Of course, there's increased debt ratios from the Multilateral Debt Relief Initiative, despite the Multilateral Debt Relief Initiative and the highly indebted poor countries interventions. And if you look across Sub-Saharan region, the estimated revenues in 15 of the 45 countries examined are less than 15% of their respective GDP. And then also the third point about the context is that the greatest policy challenge is the challenge of revenue mobilization. So if you look at the structure of these economies, it's very, very difficult to raise revenue without burdening the citizens. So there is a constant political or economic tension based on that situation of trying to raise revenue to facilitate development. Now, if you look at the post-global financial crisis, the context is one in which there's a notable increase in the issuance of sovereign bonds in Sub-Saharan Africa after the global financial crisis. The bond issuances have increased from 1 billion in 2011 to over 6.2 billion in 2014. These have increased the region's external debt stock by 147% between that period of 2010 and 2015. Over this period, Sub-Saharan Africa has debt that has risen to 133.4 billion, and the IMF estimates again that 40% of these countries are in debt distress. So you can already see that the context of debt in which a lot of these countries are operating in is very, very tenuous. So the next few slides are a bit about just the data. So you see in terms of percentage difference, how did this grow? But on average, the East Africa region has grown by 21%. The debt has grown by 21% if you look at the average of all these countries. But you can see most countries, that is, if you look Uganda, Rwanda, Kenya, and also Tanzania, it's grown by around between 17 and 9%. Burundi is the only one that has a percentage difference that's actually negative. And the explanation that we kind of came across in our looking into their affairs is that probably this is as a result of a period in which they experienced a number of sanctions due to their political context. But the rest are steadily growing as the years come across. What is particularly saddening, for instance, is South Sudan, probably because of its context, comes out from the very top at 65.2, which is a very, very high situation. So the explanations to this is that there is increased debt generally in terms of the context. The highest increases have been witnessed in Burundi and Rwanda between 2014 and 2018, respectively, over that period. I hope you can see the figures. Tanzania and Uganda have not surpassed their 100% threshold, but then Tanzania debt stock increased by 79.1%, while Uganda is at 94.7%. One of the saddening things is that there is a sentiment that a lot of this debt stock that has increased has not really translated in meaningful development. This is because a lot of the money goes back into repaying loans and budgeting for the ballooning country wage bill at the expense of economic growth. And in this particular case, we were looking at it in terms of what this debt means for service delivery. So there hasn't been much in that respect. And so many people don't feel that this debt has been helpful to them in any way. The next slide just shows in terms of national debt across East Africa. So here you can see in terms of USD billion how it's expanding. Sorry, I think I'm worried about the time, and I'd like to just continue kind of speaking to the issues and then giving the logic of what the paper concludes to. So obviously, again, it speaks to the high increase. But what is very clear is that these increases are going to bring out very difficult fiscal challenges in terms of responding to a number of economic situations. So if you take the problems that have arisen during COVID, response to emergency response, disaster response and whatnot, it has been very difficult for each of these countries to kind of give an appropriate response that can help the citizens at this point in time. Although we can still see, for instance, Tanzania has the lowest increase at this point in time. And the explanation to that is mainly because of, for instance, kind of the hardline position to fiscal management that President Magufuli has taken at this point in time. So again, a bit of a snapshot, just showing national debt to GDP ratio based on the calculations of the country central banks. And then the next slide speaks to external debt servicing as a percentage of the annual national budget. This again just goes to show how this is stressful for a number of these countries because of the priority being paying back the loans so that countries can continue showing up that they are viable entities, considering the significant amount of commercial loans that they could have taken over this period. I guess the debate here is whether this is sustainable and whatnot. This is something that is currently ongoing, but we thought that this is something we could present to our members so that they can begin understanding the conversation about what is happening in the region. Now, we also decided to look, based on COVID, how many of these countries are eligible to the debt service suspension initiative. And here we looked at all countries showing that they were eligible and which countries had requested to participate. We see Kenya and Rwanda at the time of writing had stated that they would not participate in this. I think the Kenyan situation is changing, but we are yet to see. We also have the snapshot of the potential savings in USD millions and that effect in terms of the GDP percentage points. So this is supposed to provide relief, but the estimation is still that considering the situations or the context in which commercial loans have been taken, it might still be a drop in the ocean to what is needed in terms of just helping. But I think this, I would leave to the economists in the room to kind of explain further how this would work. But the conversation is that if there is that opportunity to take this debt service suspension, then countries should consider it in their decision making. Now, in relation to COVID, this is just a snapshot of the tax rates, individual income tax, VAT, corporate tax, rental income tax, pre-COVID and post-COVID. What we see is that Kenya was the only country that kind of made some adjustments to kind of cushion its citizens as opposed to most of the other countries. But come early January, it is expected that they will be revising and going back to the initial rates. Essentially, it speaks to the flexibility of the economy, but I think the demand for taxes is still very high to be able to show up government responsibilities. And so I think for other countries, they realized they couldn't just do that. But for Kenya, I think that's the ongoing conversation in that regard. Over this period from 2009 to 2017, with growing debt, you can see how revenue collection has increased. But this is a question where from the study it will point out that there is a tightening of how revenues are collected, particularly through the use of the indirect taxes such as the VAT and whatnot. So this is an increasing challenge that governments have to deal with. So how do they find the revenue to pay off the loans? And so while this increase in revenue is welcome, the challenge is that most of it is not going to service delivery. So in terms of the currencies and in each of these countries, you can see a snapshot of that at this point in time. I'll probably be sharing this with you and you could have a better look. But we therefore went on to tell them, so what are the consequences?
You have 2 minutes.
Okay. So I think with this, we will I'll speed this up. What are the consequences of debt? At this point in time, we are speaking a lot and looking into the question because of the fears that there's a risk for default. And therefore, we want to start up on conversations, as I mentioned, about the DSSI, of the need for debt restructuring across East Africa so that we can prevent the recession or the oncoming crisis that is suspected. There is obviously the weakened resilience and greater exposure to the global financial markets and the challenges which we can also, for instance, relate to the pandemic shocks we have seen in this year. For us, then we have to ask ourselves, then what is the link between public debt and taxation? Now, first, obviously, is what I had highlighted, that there is an increased tax burden. Secondly, however, though, is increasingly harmful tax prices, which I will touch on a bit more at the end of the slides. And then a question of distorted economic development. So we have slanted taxation, more taxation towards the poor, dealing with inflation, and then increasing economic uncertainty. So then, in closing, we ask ourselves then, what are the questions of tax justice in relation to the public debt? First, we ask ourselves about fairness of tax policy in East Africa. The region is increasingly talking about tax reforms in East Africa. But what do these tax reforms mean in reality to the people, for companies that are involved in this, for the day-to-day person? What do we mean by tax reforms? Who will be burdened, or who will it help? And so that's one of the issues. Second, in terms of fairness of tax policy, is the question of processes of funding political promises. A big chunk of the burdens that we are finding ourselves are because of ambitious political promises, whether it's infrastructure and so forth. There is a political process that is made, but it's not thought out properly, and therefore you just have to look for money anywhere in order to fund it and keep the electorate happy. But so these processes, we feel that are things that need to be interrogated. And then we have to ask ourselves what are appropriate means to achieve domestic revenue mobilization. And then how do you tax someone to become a more productive entity in society? Because production is the driving factor in more prosperous economies. So that conversation is important. Secondly is the questions of illicit financial flows and harmful tax practices in East Africa. So as we had spoken earlier about harmful tax practices, there is obviously some contestation of what we mean by illicit finance, just understanding that and what those flows mean. So putting out to people and making them understand why tax avoidance is an immoral and problematic issue. Secondly, why are we finding ourselves in the increasing formation and linkage to tax havens? So in that regard, we are examining why the need for international financial centers and what is their impact in the region with the formation of the Nairobi International Financial Center and the Kigali International Financial Center. And the third issue under IFFs and harmful tax practices are the emergent treaty networks and how then they facilitate illicit financial flows. So in this regard, other than from this study, we have seen and started to map out the treaties in the region with the top 10 countries that have signed on to DTAs in the region, being the first place being South Africa and the United Arab Emirates that have 4 treaties each. India and Mauritius have come in second place with 3 treaties each. China, Iran, Korea, Kuwait, the Netherlands and Singapore all follow with 2 treaties each. Then obviously the question of economic growth and resource distribution. So the finance of projects, mainly through debt. So we are looking at making the correlations and the need for PPPs and how we are accumulating debt, challenges in revenue mobilization, the focus on infrastructure-led growth, how is this affecting the region, and stresses on service delivery due to such projects. And lastly, the question of empowerment of citizens and inclusion in the city of their voices in fiscal policy making. We find that public finance management is already an exclusive policy space, but it is becoming more isolated the more we accumulate debt. If we take the issue of double taxation agreements for one, or even the budget making process, there is a lot of sidelining, for instance, of institutions like Parliament. So how does this play out in terms of development of countries? And so this is the part of the issues that we are trying to highlight with this study, so that our members can easily begin to understand and participate more in these conversations. I hope I managed to keep to the time, but thank you very much for listening.
Thank you so much, Leonard, for such a very brilliant presentation. It was such a rich study, and it brings out the entire issue around debt distress within the region, but it also brings out issues around other parameters of debt, the PPPs, but also issues around equitable taxes and also the need to plug the leakages. So, and also very important, the issue of voice, the issue of transparency, issues around accountability. So thank you so much, Leonard, for that study. There is some questions which have been put to you, but we'll look at those questions, the questions later. Thank you so much. So I would like to turn to Jason, who is going to make a presentation on COVID-19 debt sustainability impacts and economic rescue packages analysis in the SADC, in the sub-region. Jason, you have the floor. You have 15 minutes.
Thank you very much, Jane, and very nice to follow on from Leonard. I'll try and see if the technology works for me and see if we can get my presentation up. So just bear with me a second. So here we go. Okay, great. I hope you can see the screen and the presentation. So yeah, thank you very much for organizing this. And just by way of brief background, the African Forum and Network on Debt and Development is a Pan-African civil society organization that advocates for debt relief and debt cancellation, as well as a broader mandate around economic justice matters, including tax justice. So it's very nice to be back amongst friends speaking about a very important issue as we deal with the current COVID pandemic impacts. So in terms of my presentation, I want to focus on about 6 things, and I hope that I can speak very quickly through all 6 of them without having to repeat what has been said by Leonard. But certainly it's first of all understanding the SADC region, but also the wider continent in terms of how we've come to the situation that we're facing with the current debt crisis. So it's the landscape, and then there's what I've called the hunger games, the appetite by both government and lenders to borrow at any expense. And then third, it's about borrowing today and pay tomorrow, and the role of new actors, particularly the privatization of development and how this has impacted in the SADC region. And then, of course, to the crux of the issue, is it jump or be pushed, and how the COVID-19 pandemic has accelerated a lot of the crisis that we're witnessing, not just in East Africa, as Leonard has presented, but also in SADC and across the continent. And then I'll touch a little bit more on the debt relief efforts and sort of offer some commentary there, and sort of tie it in again with what Leonard has talked about in terms of remedial things and at the core of this challenge that we're facing. So what do we mean when we say about Johnny come latelys? So this is, the debt landscape has changed considerably since the HIPC MDRI time over 15 years ago, when we had what we consider our traditional borrowers and lenders, where it was mostly bilateral relationships between government and government. As countries have developed and grown, particularly on the continent and across EAC, the East African region and SADC, there's been this emergence of alternative finance that has taken place, and financing options. And what this has meant is a lot of governments, through also advice that they have received from development partners, have opted to sort of explore alternative financing instruments and options for financing their development. And critical to or key to these alternative finances have been private creditors, private banks, bondholders, commercial lenders, as well as non-traditional bilateral lenders such as China. And you can just see some of the statistics there in terms of how the debt portfolio has evolved over the last 15 years, and what it looks like for the continent. It is quite startling. And this does play a significant part in how we approach the pandemic, and therein the fiscal stimulus packages that have been instituted by different governments to try and protect both citizens as well as businesses from the vagaries of the pandemic. Again, just to sort of provide some context in terms of, I call this the hunger games, and the reason I say this is because as countries have developed and have grown, so has their appetite for borrowing. the emphasis, particularly from, again, development partners on things like heavy infrastructure financing at potentially the expense of job creation and wealth creation, investments in productive sectors, has meant that, you know, there has been an ignoring of those sectors and a direction move towards heavy infrastructure. So whether it's roads, railway lines, big energy projects, and in particular the inclusion of other non-traditional lenders and creditors to the financing pool has meant that, you know, making this accessible, finance accessible, has meant this appetite by both governments and lenders has increased over the last decade and a half, and has sort of put the continent onto a pathway towards, you know, the sort of situation where we're experiencing right now. And so you can see the kind of things that or purposes why governments have and lenders have increased their appetite for lending. These structural purposes, market development, cyclical, and then political purposes. And you can see that this, you know, all these combined has also whetted the appetite for your non-traditional lenders and creditors to enter the game, as it were, the game of loans, as this webinar has been dubbed. And you can just see here in this particular chart, you know, how the debt to GDP ratios in the SADC region have changed over time, and it's quite significant. The spikes, particularly, you can see the dots, the orange dots. I hope it's visible on your screens. And of course, you know, the privatization of development has led to, you know, our continent sort of looking like this. And you can see in the SADC region, you've got Zimbabwe and Mozambique, who are, you know, classified under the IMF risk map as being in debt distress. You've got Zambia, Angola as high risk, and then sort of Namibia, Botswana, moderate risk, low risk, and South Africa, low risk, and Madagascar. And then Tanzania also at low risk. So you can see that, you know, it's quite a mixed bag in the region, but generally the trajectory or the overall image of the region is not necessarily that positive in terms of what is currently happening. And of course, there's Malawi sort of sandwiched between there, that's also in moderate risk of debt. And what does this mean in terms of what has been driving this? So, you know, there's been, countries have grown, they've graduated according to World Bank classifications from low income to low middle income, or even middle income, particularly in the Southern African region. And what this means is their ability to access concessional finance has actually decreased. And that means they've had to opt for non-concessional loans and also look elsewhere for financing. And as a result of that, because they can access these alternative markets or these alternative sources of finance, it means that they have readily gone there without necessarily having the proper foundations and macroeconomic fundamentals in place to borrow or to explore these alternative financing models, particularly from the private creditors. And then, of course, the non-traditional bilateral lenders, when you look at the likes of China, their sort of approach and their investments in the region have been very much tied to assets, and as a way how, you know, their behavior is not necessarily how traditional lenders have behaved with countries in the region. So we actually see, as a result of that, you know, that the appetite to lean that way has also grown. So lesser conditionalities in accessing these alternative finance instruments in the initial period, but when, you know, as we're now witnessing, as the debts come due and come due for payment, then all of a sudden the devil's in the details that were overlooked during the loan contraction process, during the negotiations. All of a sudden we realize how dangerous these easy access instruments are tending to be, as we can see in the case of Zambia, Mozambique, Angola, and so on. And so a further interesting aspect here is on the Eurobonds. And the reason I opted to sort of bring this in is because it's also linked to part of the presentation that Leonard made, and just to highlight some of the risks that have been associated with bond issuance in terms of the repayment at maturity, the sinking fund, and the fact that it could be unsustainable, the currency denominated, which poses a huge risk and in fact is a massive risk in the SADC region, and of course the interest rates. But one other thing that has emerged, and as Leonard alluded to in the case of Kenya, is the contracting nature of the Eurobonds, or the loan contracts with the Eurobonds. In the case of Kenya, I think the Cabinet Secretary for Finance recently announced that part of the reason that has been a delay in them trying to or attempting to apply for the DSSI is because there is a clause within the Eurobond contract that stipulates if they do try and apply for any type of debt relief, the Kenyan government may be considered or might be considered to be in default of the Eurobond. So things like these are just very critical aspects in terms of how difficult and challenging it might be with this increased appetite and an increased direction towards the privatization of development. So jump or be pushed. So what has happened in SADC? Basically, the over-reliance in the region on natural resources in particular has been a major player and a major factor in how the COVID pandemic has accelerated the crisis in the region. And as you can see, some of the numbers have really peaked and spiked over the COVID period. And this is just to say that some of the countries were already on this path towards entering being in high debt distress. However, because their fundamentals were not in place, because of the manner in which they were borrowing was not consistent with their laws and policies, and I think this is also something that is consistent with what Leonard has mentioned in the East African region. We've seen that a lot of the slowdown that has resulted from the COVID-19 pandemic has affected tax revenues, particularly in the natural resource sector, mining, oil and gas. And this has had a significant impact on the ability to raise tax revenues, which would be used to in part to service the debt, but in part also to invest in basic social services like health and education. So we can see that the vulnerability in the region has gone up, and as a result of that, the initial growth rate for the region has been revised downwards quite significantly, and it's expected that there will be a further contraction the longer the global lockdown continues. And so this is something that we need to pay close attention to, because the slump, the path out of this pandemic for the region, because of its reliance, particularly on things like tourism and primary commodities, might actually impact the duration of the path out of the pandemic. And here's just a snapshot of what some of the countries in the region had instituted throughout the pandemic by way of fiscal stimulus to support both the health sector specifically, but also towards social protection and small and medium enterprise support. So you can see that there has been significant investments that have been made by governments in the region to try and cushion as much as possible citizens and businesses as well. But as I mentioned, the longer the pandemic continues and the longer the lockdown and the inability to trade effectively continues, then we may see that some of these packages are not necessarily going to be viable, and as a result of the debt becoming due, governments are going to be faced with a very difficult decision as to whether they continue providing these stimulus packages, or do they start diverting these resources to sort of keeping their creditors happy, particularly creditors like private creditors and China, non-traditional lenders. So where does this leave us in terms of our advocacy, in terms of our conversations with citizens, with governments, with international players in the debt space within the region, but also continentally, and linked to Leonard's presentation? So we currently have the Debt Service Suspension Initiative, which is, the initial response to sort of the pressures, the fiscal pressures that many countries in the region, both in Eastern and Southern Africa, were facing, but also across the continent. However, there are some significant challenges. Whilst, as Leonard said, many countries in the region have qualified and have put their foot forward to accept or be considered for this. A big actor that's out that has not been included in this program are the private creditors, to whom the continent is the biggest creditor. And without them on the table, it is quite difficult for any meaningful and long-term sustainable debt restructuring to actually take place. So I've dubbed this "Giving Paul to Pay Peter." For those who are familiar with biblical parables, there is a parable around this where the risk we face in the region is that the bilateral debt relief we may receive through DSSI might not actually be used to invest in social services like health, education, water, and sanitation, but may potentially be diverted to pay off private creditors in order to avoid defaulting and avoid prolonged legal battles and legal cases in terms of not being able to pay. So we need to look at this and see how we can address that issue. And of course, there's the World Bank facility as well. Some of the other options that to be considered are the SDRs, as an alternative to the DSSI, or in addition to the DSSI initiative. And to conclude,
1 minute. Okay.
To conclude, this is my last slide. Yeah. So to conclude, what does it all come down to? It's stop the bleeding of the continent, right? We're leaking left, right, and center. I think Jane started by saying that this is a trifecta of fiscal challenges, and I think in just the last webinar I was in a few minutes ago, Alvin also mentioned it. But it's exactly that. We're bleeding everywhere, and so it does come down to trying to stop the bleeding, reforming the global architecture, and stimulating domestic resource mobilization. And how we see this in the SADC region, for example, is increasing debt transparency. And whilst the pressure is on borrowers, I think as AFRODAD, what we've been saying is this cannot continue to just be a borrower issue. The transparency also has to be on the lender, and therefore some level of responsibility and some sort of needs to be placed on creditors, particularly private creditors, because as with tax treaties or with illicit financial flows, many private agents go into these negotiations or go into these transactions in the full knowledge that they are doing, they intend to do more harm than good. And I think it is David D, a Kenyan economist, who spoke recently about why investors still go to Argentina despite them defaulting 3 times in the last decade. So, private agents are aware, so there has to be a responsibility there. I think redesigning the global mechanism to allow for a sustainable restructuring, this has been on the cards for a very long time under the UN principles on sovereign debt restructuring. And I think the IMF has an important role to play here as well, because they're seen by private agents as somebody who can balance the negotiating table and actually facilitate and enable some sort of deal to be brokered, as we're seeing in the case of Zambia, where a program will, if a program does come up, it may actually help them negotiate with all their creditors. Curtailing the role of enablers, we've talked about this in the tax context. You know, we've talked about accountants, lawyers. In the debt context, credit rating agencies are quite dangerous in terms of the corner that they're putting developing countries by threatening not to, by threatening to downgrade countries for not being able to pay. And we've seen this happen in the case of Zambia. Debt sustainability is not about, it is more about use of debt, appropriate use of debt and a loan contraction to stimulate domestic resource mobilization and generate taxes. And then of course, you know, it's all consistent with the Addis Ababa Financing for Development Conference on DRM in order to increase tax to GDP ratios. So thank you very much. And it's been a pleasure.
Okay. Thank you so much, Jason, for such a brilliant, very interesting presentation. And I have liked the Hunger Games and, you know, the borrow to pay Peter, pay Paul to pay Peter. Very, very interesting, but that's the reality of the situation in Africa. And you know, your presentation shows that both regions, SADC and EAC, we are in the same sinking boat. But it's also good that you brought out the way forward, what needs to be done, and we can be able to discuss those proposals that stop the bleeding and what can be done. So thank you so much, Jason, for a very good presentation. I'm going to turn to Isabella. Isabella is going to talk to us about the IMF perspective on prudent debt management. But Isabella, you can also talk about the presentations by Leonard and Jason. You can make your comments there. You have 6 minutes. Thank you.
Thank you. Thank you so very much for allowing me to participate in this panel. Well, I have to admit that a lot has already been said and shown by Leonard and Jason, and I can see you're on top of all the IMF projections as well. So I'm going to just confirm some of the messages, you know, including on the initiatives of the international community that Jason has mentioned, and I have to reassure you that we are all working in the direction of us not having to watch all those horror movies that you are referring to, like the Hunger Games and the Game of Thrones. So we are all on the same page, and we want to avoid this very, very difficult situation and address the problems that have arisen in the near term. So it is true, half of the low-income countries were already at high risk of debt distress in 2019. This is something that has been mentioned. And the pandemic has actually worsened this picture. And here, yes, I can connect to Jane's mention of the triple jeopardy. We have seen revenues collapsing, expenditures for COVID-related items have increased. At the same time, spreads have widened and exchange rate pressures have manifested. And all this contributed to a further increase in debt levels that were high already prior to the pandemic. So we have estimated that between 2019 and 2020, low-income countries' debt has increased by between 7 and 9% of GDP on average. This increase has been even higher in middle-income countries and high-income countries that have higher access to the markets. So debt issues have, you know, featured prominently in IMF work even before the pandemic. And you know, but during the pandemic, what we have done is that we have extended some financing to help the countries cushion this situation. Although you know, the rise in poverty we are observing is very sharp, and it is something that we will have to deal with in the coming years, the high debt levels and the high poverty ratios. So far, some 83 countries have received financial assistance from the fund, mostly through our facilities, the various RCFs and RFIs. The fund has also provided debt relief to 44 of its poorest members through the CCR, so-called CCRT facility. And the ongoing DSSI, the Debt Suspension Initiative, Jason has talked about a little bit, benefited some of the low-income countries. And these efforts have succeeded in flattening the curve of distress to some extent. So despite the fact that we have seen many downgrades, we have not seen many debt defaults, very few, and actually some of these were in the making already prior to the pandemic. However, going forward, we do expect to see more defaults and more countries with high risk of debt distress. So against this background, the IMF has a very comprehensive work agenda ahead of us. So first, the initiative we talked about already, the DSSI, we think there is scope for bringing the effective relief closer to the fully eligible amount for countries that have not yet obtained it. And to cover the debt service suspension period to 1 full year, and also extend possibly the initiative through 2021. It has recently been extended to March only. And we think that longer grace periods and repayment periods would also reduce the prospect of bunching of the repayments in the post-COVID recovery. So a second is, something that Leonard has spoken a bit about. We have seen post-HIPC that debt ratios have increased in the Sub-Saharan Africa, and I'm going to show you just a figure, and he has shown an interesting one already. I don't know if you can see this. Sorry. Basically, what we are seeing is an increase in the debt ratios, but also, sorry, I'm struggling with the slide here. But also an increase in the debt service ratios. And this is due to the fact that the debt has deteriorated. So basically, whereas previously the multilateral and Paris Club creditors represented the majority of borrowing, nowadays other sources of financing have replaced these principal creditors, and this has provided alternatives to the countries, but has also deteriorated the cost of borrowing. And if you can see in the right-hand chart at T is the year when the countries have received the HIPC debt relief. And going forward, you see the debt service to revenue ratio increasing, particularly sharply in the last few years. So, what the fund is trying to do. So we have supported the adoption of the side of G20 of the common framework for debt resolution beyond the DSSI to bring the Paris Club and non-Paris Club creditors together and apply comparable treatment of private debt in terms of debt resolution. And this is something that should help facilitate that restructuring and coordinate, but allow it to be also on a case-by-case basis. And it should also facilitate burden sharing across creditors when needed. The resolution should also be faster, and the cost to both creditors and debtors would be lower. We are also trying to promote the use of collective action clauses in contracts with a broader range of borrowers now using these protections, and could facilitate also the majority restructuring of loans. So we think that also a reform of collateral is needed, and an increase in transparency of that. There is also scope for using more state contingent measures, which is a possibility for countries to repay their debt when larger shares of service when the cycle is favorable. We have also revised our debt limit policy. And finally, and I think also importantly, we do continue to do our part in supporting countries by carefully designing IMF programs, sound macro frameworks. We strengthen the use of the debt sustainability analysis. And more details on all these initiatives could be found in two of our very recent reports. One has actually been published just yesterday. It is an update of the joint IMF World Bank multi-pronged approach to address debt vulnerabilities. And here I'm going to show you a summary of the pillars that are encompassed in this approach. Basically, it is organized around 4 mutually reinforcing pillars. One is the strengthening of the debt transparency by working with the borrowing countries and creditors to produce better public debt data. And this is what Jason was saying about, while the primary responsibility is on the borrowers, that, there is scope for creditors also to cooperate in this area. The second pillar is supporting the capacity development in public debt management to mitigate debt vulnerabilities. 3 is providing suitable tools to analyze debt developments and risk. And finally, we're adopting the IMF and the World Bank surveillance and lending policies to better address debt risks and promote efficient resolution of debt crisis. So another, let me stop sharing. So another report that is being discussed by the board is in November is the reform of the policy on public debt limits. And this is our review of our 2014 framework. And the objective of this review is to clarify the definition of concessionality and also encourage the use of net present value in the assessment of debt sustainability for countries that are at moderate risk of debt distress. Going forward, we will be reviewing our policy of lending into arrears. This is something that we have in plan for the first half of the next year.
Thank you so much, Isabella, for that presentation, and also for clearly spelling out what IMF is doing to help developing countries address the debt issue and the debt distress. But maybe what we need also to ask ourselves is whether what the IMF is doing is enough, or we should be asking for more from IMF. I would like to call upon Alvin Musioma, who is the ED Tax Justice Network Africa, to give us the perspective of debt from a Pan-African perspective.
I think that the two brilliant presentations that both Jason and Leonard made preempted any kind of new ideas that I might contribute to this conversation. AFRODAD, being the eminent debt organization in the continent, I think provided quite some perspective, and even the presentation that Leonard made, I don't think that there's really a huge characteristic difference between the debt that we see in the East Africa region as it applies to other regions. Nevertheless, I'll try to, within the time period presented, sort of provide some perspectives building up on the presentation that the three colleagues have made. I think I'll start by sort of building up on the triple jeopardy that Jane, you started with, really what I can call a fiscal trilemma that many of the African countries face, which looks at, on one side, the collection aspect, which I think Leonard touched a little bit, the debt and the expenditure. And I think that this conversation on debt financing, I think will not be complete if we have it only in silos, basically looking only on the debt question, because if you look at the justification for the kind of growing appetite for the debt Jason was mentioning, links it back to the kind of fiscal deficit that many of our African countries are facing. There's a huge gap in terms of the amount of revenue that they are collecting vis-a-vis the demand, be it in the social sector or the infrastructure sector. It is estimated that particularly, for example, only take the infrastructure. This means that the African infrastructure gap is about over $90 billion. So when you look at these and try to contextualize this kind of trilemma, I'm looking at, are we collecting enough? Are we borrowing properly? And are we spending it enough? I think those are the three questions that are interrelated, and I think that this conversation should be kind of should be focusing on. And if you look at the collection side, I think that one way, even if we were to look at the debt question by itself, one way of mitigating the negative impact of debt we are seeing in the continent is to try and grow the collection envelope. That would contribute to reducing the fiscal deficit. And why are we not doing this? What we see, particularly in the collection part, is that the fiscal policy, the tax policy of many African countries are very weak. We have very weak tax policies that are significantly undermining effective tax collection. There is a huge focus on the so-called easy to collect taxes because, again, the perception that the weak institutional framework that characterize many of the African countries, there's been an advisory that the VAT is the tax of the future. If you look at the level of informality that characterize many African countries, there's that kind of policy advice even coming in from institutions such as the IMF, saying, oh, you need to focus on collecting on the VAT, despite the regressive character of this system, which had basically resulted to a very regressive tax design across different countries in the continent. There is the question of institutional capacity, the capacity to collect, which again is severely limited, starting already from the policy design perspective, from the Ministry of Finance, the legislative, the role that parliaments play in terms of legislating effective tax policies, and even the area of tax administration. And this is despite the major investment that has been made globally through, for example, the Addis tax initiative or the tax inspectors without borders that have tried to invest in building the capacity of particularly revenue authorities. The prevalence of aggressive tax avoidance and tax evasion, which according to the recent statistics from the UNCTAD showed that the level of illicit financial flows in the continent, the bleeding that Jason was talking about, is we are not only mitigating that, but the problem is becoming worse. The MBECI report talked of 50 billion. The UNCTAD report talks of over 89 billion. So the problem of the revenue outflows from the continent is becoming worse, despite all measures that are being put in place. And as the result of this revenue leakage, it's obvious then to assume that as the public coffers become more constrained, governments are gonna the contraction of government revenue is one of the major causes for the kind of debt rises that we are seeing. And I think this connection is very important, that this connection is made. The rise of harmful competition between states in the effort to attract investment, which is resulting to the race to the bottom. And I think Lena did mention the role that the exploitative treaty network is playing in terms of providing avenues for aggressive tax avoidance and tax evasion. The solution here, I think, is we need to invest more in tax gap analysis, and I think really to try and see that are we exploiting the potential for revenue collection. And I think this, if there would be an advice, particularly to institutions such as the IMF, is really to invest more in this while mitigating the impact of debt. In the short term, I think is an urgent and immediate steps, but looking at the revenue potential and how can we be able to support African countries to exploit their revenue potential, looking at the different revenue bases through a serious tax gap analysis, I think, will be critical. I will not want to repeat the critical points that were being made when it comes to the debt issue. I think the high debt to the high debt to GDP that we are seeing is making many countries vulnerable to economic changes, significantly reducing the ability of states to provide economic support. And I think the question here really end up kind of going into question and answers. When you look at the solutions or that institutions such as the IMF are putting in place, the question that comes into mind is, what have we learned from the HIPC era? When you look at, are we repeating the same kind of solutions? What lessons have we learned that led to the HIPC era, and are we repeating those lessons? I think that will be really critical as we design new solutions, and I'll really be very curious to hear more about the tools that the IMF is putting in place and the advisory that it's providing to African countries, ensuring that there are new players in the room, as Jason was saying, the role that the private actors are playing, the role that China is playing, and therefore I think as we think around the solutions, it's very important that we are also drawing from the lessons from the past, particularly in the HIPC era. When it comes to the expenditure aspect, I think what we notice that many governments in the continent are caught between the rock and the hard place. On one side, there's particularly as a result of the COVID crisis, the pressure to provide tax relief to businesses and taxpayers, while at the same time to consolidate the tax collection. This, I think, is also opening up the avenue for the demand for debt repayment. The issues around the unsustainable recurrent expenditure, the estimate ratios are like when the money is being borrowed, where is it going? And a big part of that, if you look at the ratio between the recurrent and the development component of the expenditures, 70 to 30 is the average across the continent. And this really is leading to a situation of unsustainability. The increasing wage bill, I think Leonard did mention that, and of course the cost of borrowing, which comparatively, if you look at it within the Africa region and developing countries vis-a-vis what the richer nations are able to access debt, the cost for borrowing for many African countries has been growing. And lastly, I think the point I would like again to re-emphasize is this growing appetite for public-private partnerships that are kind of creating the pathway for mega investment projects that again exacerbating the demand for debt financing. So all these put together, I think, Jane, my assumption is, or the point I would like to emphasize here is really that in this triangle of debt, tax, and the expenditure, I think the solutions that going forward need to lie in between there, ensuring that we are borrowing for the right reason, we are investing more in the social sector as opposed to striking the balance with infrastructure, but also putting a regulatory framework, as Jason was saying, that not only focuses on those that are borrowing, but also shifting the responsibility to the lenders. I'll stop there for conversation.
Okay, Alvin, thank you so much for that great presentation. I have liked that triangle, the debt, the tax, and the expenditure. And also ensuring that we reduce on our appetite on current expenditure. And I think the way out, what you are saying, the way out of the debt trap is to be able to focus more on DRM, to focus there and also reduce the leakages, but also make DRM more equitable. Our last speaker is Julius Kapwepwe, Deputy ED, UDN, and he's going to give us insights on public investment and then sustainability in Uganda. Julius, the floor is yours.
Thank you, Jen. I hope I'm audible enough.
You are, Julius. Go ahead.
Thank you. Yeah, I was given only 5 minutes to make my presentation, which I think is larger and fair. We shall settle it in the courts of law in Uganda, but that will be another day, not today. I'm also lucky that in principle, two things, the various struggles that we have taken on as African civil society actors, particularly civil society, before the World Bank, before IMF, as Isabella has shared, are gaining some fruit. To that extent, I'll have a nice evening. The other bit is that when you are speaking last, then at times you are lucky because then a number of areas have been raised. So I'll make it as short as possible with the risk of maybe repeating a bit that has been said. I expect my presentation from the SEATINI team, but yes, I'm glad it is there. If it could be expanded a little bit. Basically, why the rise in the debt, that has been ably answered. And when I looked at the historical perspective in the case of Uganda, I actually saw that this situation has been with us even in the pre-colonial independence time. And a number of examples come up. I've only picked one for purposes of time. That as at 1st June 1961, we had already acquired a loan for construction of a hydropower plant in the Jinja area, which is a bit of eastern Uganda. Siom, I think you've been there. And it appears that we have never run away from that kind of indebtedness in other fronts, even if this finally was dealt with. But that seems to be the kind of the historical perspective in the case of Uganda. And also when you check across a number of African countries. So why does it continue to be that way, and what is it that could be done so that we cut off the yoke of indebtedness and of impoverishment? Incidentally, for me, it is impoverishment as opposed to poor countries. The other bit, of course, which also has been touched on is the global interest. If you looked at the case of China, looked at the case of Turkey, looked at the case of India, and many others, the Western world, and vis-a-vis coming into Africa, and also making effort into fitting the African frameworks that have been given. And of course, of late, obviously, the effect of COVID on borrowing. And then in my slide 4, where I've said that towards sovereign debt sustainability, which way, how should we go about it? I've said, just like has been said earlier, the debt transparency aspect is to mention the obvious. Beyond, for instance, publish what you fund, to publicize what you fund. If you looked at a country like Uganda, access to internet, for instance, and therefore websites of IMF, the World Bank, African Development Bank, Islamic Development Bank, and many other financiers, the access is extremely limited. So how do we invest into other strategies of publicize what you fund, so say on a quarterly basis or whatever period of time, so that citizens can have access to what is to information on what is happening, and then we are able to work with you. We become your foot soldiers, you the financiers, and we are able to alert you that, oh, this is what is happening in region X, this is what is happening in region Y in respect to project X. And I've just picked out 2 projects, for instance. There was a famous, or rather infamous, the Master Fisheries Plan of 1999 in the case of Uganda, involving the African Development Bank and involving about $22 million for fish multiplication and development of the sector, since we are targeting the EU market. I've also seen similar loans acquired by Kenya and a number of other African countries. The long and short story of that is that as we speak today, East Africa instead is importing fish from China, as opposed to these kinds of efforts that were simply put to a waste. In some of the cases, however, there is where debt that has been acquired from the debt performance or outcomes perspective has really achieved well. And I've only picked one particular case of roads. Maybe that is quite easier and obvious to look at. The roads that are connecting Uganda, for instance, the hinterland of Uganda to the border point with Kenya and on to the seaport of Mombasa. But similarly, the rails that the ways, the access that leads us to Dar es Salaam port and therefore the rest of the world. There has been positive contribution as a result of borrowed resources. So it's on a weighing scale. I think overall there has been positive development that we've gained from the net gain from the borrowed resources, as opposed to a bit of hiccups that have happened in some of the projects. But I think also speaking to that is when I look at Moody's and Fitch and some of these rating institutions, including government, there has not been full or genuine disclosure of the public debt portfolio. I see the emphasis is always on DOD, disbursed and outstanding for that matter, as opposed to other components of debt. Therefore, even when you come up, Leonard, and you say Uganda seems to be okay at this percentage, some of us think that we are actually past some of those percentages. Why? Where is the contingency liabilities in the equation of debt? Is it a component of public debt or is it not? Where is the component of publicly guaranteed loans? Is it a component of public debt? Is it not? Where is the component of domestic arrears? Where is the component of recoverable costs, for instance, if we looked at Uganda and East Africa generally, where we are investing in mineral development, particularly oil in Uganda and Kenya, but also in the Mtwara areas in the case of Tanzania. The recoverable costs, the initial investment that private companies will have to recoup upon the flow of oil and such mineral resources must necessarily come into the debt profile equation. Then upon that, we can have a clear assessment of where we are standing. So I like it, Isabella, when you contribute that there are efforts in revising some of these instruments, but I think we would be glad to contribute to those elements of revisions so that we are able to bring this conversation to more profile quickly, the other bit in terms of then how do we ensure the sustainability in terms of the investments. That debt, we should leverage that debt that plays a catalytic role and not more burden. Therefore, the initial feasibility assessments and availability before a loan is finally signed off, the IMF particularly, because you are more listened to than many of these other institutions, including the global ones, by some of our governments, you could kindly help us in those areas so that we are able to see a pre-assessment, full assessment of the tangible benefits we expect from some of the loans that we are acquiring. But also the aspect which you touched on as well as AFRODAD, beyond DSSI, some of us are standing for total debt cancellation of multilateral, of the bilateral, and the private creditors. And also going forward, requesting IMF that it should spearhead this effort that brings everybody that we owe money as low-income countries, as East Africa and SADC, as Uganda, into one bracket, and then we are able to agree on total debt cancellation. Because if you continue squeezing the nose, it will generate blood. So where will this money come from? If the IMF has been categorical on the remittances and what has happened, the tourism revenues and capital inflows, generally what has happened. So where should this money come from unless we have total debt cancellation? 100%, and then we come back to the drawing board on how we could be able to have the low-income countries and also a country like Uganda begin on some footing to recovery. The other bit for me close to that is IMF to continue cautioning our governments on slowing down on commercial debt. Another bit for me is for sustainability to be IMF and a number of other international actors as well as ourselves drumming up against the government for recovery or refund of stolen debt related and other resources. If we don't do that, it's like having a leaking container. It doesn't matter how many times you go to the well, therefore the expanding domestic revenues or acquiring new debt, as long as there is a leaking bowel somewhere, it will continue to be a recurring problem. How do we squarely face it amidst diplomacy and many of these other areas that tend to limit our outspokenness? I think until we get to that level, we may not register the sustainability of debt elements. The other one quickly for me is linking the DRM discussion with fighting IFFs, and Msioma has been categorical there. But also, how do you expand DRM without burdening households who are already indebted in case of COVID and even the pre-COVID time? The corporate entities that have been giving us corporation tax, for instance, and other areas in terms of revenue contribution, but now are also grappling with increasing indebtedness. So that bit, I think, we'll need to see how best do we draw a balance beyond simply talking about expand DRM, expand DRM, expand DRM. Then the bit that also has been touched on is the hemorrhage that we are seeing through the PPPs. Of course, part of that, if interrogated the compact, say for Africa, with Africa, by the G20 and a number of other actors, it seems rooted there. But how much of that is creating capacity for African governments to ably deal with PPPs so that no one is fleeced at the end of the day? Unless we do that, I think there is going to be continued unsustainable debt, sovereign debt in some of these aspects. Related to that for me is strengthening the functional capacity of African CSOs and citizens' effectiveness generally for accountable governance and core in that respect. Unless that happens and many CSOs remain, say, in mediocre kind of capacity and survival kind of moment or orientation, it becomes difficult to mobilize citizens to stand against excesses of government in some of these cases. While we may blame anybody elsewhere, a China, a World Bank, and all of these details, the accountable governance issue back home remains very, very, very key. And as that discussion happens, we'd also need to link it with how do we reform governments of our nature so that we can release money from the recurrent, ever-increasing recurrent, including non-essential recurrent spending areas. How do you release those funds to give way to development expenditure? Unless that happens, it doesn't matter again how much money you generate through DRM or any other mechanism. You'll still just be expanding the stomach of government to simply consume. And also, on a lighter note, the gens of this world should participate in being members of parliament, be the political actors, be the good quality of political actors that would wish to see. We cannot keep lamenting back home when we are not taking up some of those spaces. So while you have the economic aspects on the other side, there are also governance aspects on the other side of the continent, and we need to keep looking at all that conversation. And lastly, for me, I think it is high time, and unfortunately, I don't have all the time to delve into the details, but it is high time that we started the conversations or even acted from state divestiture to a strategic business investment state in certain areas of the economy. In the case of Uganda, the private actors have come and simply fleeced us off as citizens and taxpayers in the railways subsector. As an example, government could strategically invest in that area, kickstart it. Once it takes shape, then you can float it on the stock market for the private sector to take it up from there. But I think in our context, the private sector generally has been overrated. That the private sector will simply provide this, that will do this investment. Government, you must divest yourself out of this. I think that conversation built in the Washington consensus and many of these discussions needs to come back to table with the view that the government can kickstart investable projects in certain subsectors that are key and then could be handed over once they come to maturity or at break-even point. Thank you.
Thank you so much, Julius. You have put on table so many proposals, but the one on honorables, I have seen honorables who go to parliament and become dishonorable. So it's no guarantee, but thank you so much for that presentation. There are very many issues you have put on table. The issue of disclosure of the debt portfolio, that's really, really critical. And the issue of debt contracting and negotiations, and the whole issue around debt governance and the participation of other state, non-state actors in all these processes. So thank you so much for that presentation. We are way out of time. I would like to give just two people to ask questions, one each. That's Irene and OC Chibowa. Irene there. Irene Muita. If you are not, I'll ask OC Chibowa to ask your question.
How do you unmute?
You can use mine. It happens to be here next to me. Come.
Okay, thank you, Isabella. So my question goes to you. According to data that we've collected from the World Bank, the Service Suspension Initiative website, potential DSSI savings all EAC countries have averaged only 0.2% of their respective GDPs. So I would like to understand what other measures is the IMF taking to expand the reach of the DSSI for countries specifically in Sub-Saharan Africa.
So thank you for the question. I talked a little bit about that. The amounts are the ones that you have seen, and even for those amounts, there is some burden on the side of the countries to request this financing. We are advocating to extend the initiative beyond the current period. But we are also looking at other ways to help the countries. Now, in the context of our programs, we can help, some of the things that we have talked about today, like debt transparency, which is extremely important, help step up revenue mobilization, and address the public expenditure challenges, because as we have seen from the discussion today, what Alwyn was talking about and Julius, debt management plays an important role in addressing that vulnerabilities, but fiscal policy is the key driver of public debt levels. So we have to be concerned about all of these issues about revenues, but about governance as well. So so what we stand ready to help with our programs. We can provide extremely concessional financing. We have programs with 0 interest rates, 5-year grace period. This can give some respite to countries. If the funds are well invested, it will put them on a stronger growth path, and repaying those contractual obligations that are more expensive, that have been incurred over the past, will be easier going forward. We are also providing support in capacity development, in debt management. We help the governments perform debt sustainability analysis, which together with those improvement in debt transparency could unlock further funds, further financing from other donors.
Response. Irene also had a question. Irene, are you there? The unmute button, but I can read her question, and again it goes to you, Isabella, but also she's okay. Isabella, can you please?
Hello.
Yes, please go ahead.
Okay, thank you. I didn't have the unmute button on my screen. Sorry about that. So my name is Boke. I work at Transparency International Kenya. I have just one question that we've been wondering how we can go about it here in Kenya. We have a coalition that works on public debt management issues, prudent debt management, and for a while we've been struggling with access to information in Kenya. Information that is publicly available is either very, very outdated. You get the 2013 version of information that might not necessarily help us and citizens in holding leaders to account right now, because it's really old information. So I was wondering, or my question really is, can international financial institutions like IMF put some kind of, requirements that if we are going to give you loans, then you must be accountable, 2, you must be transparent to the citizens on how much loan you have acquired, what you're using this loan for, and actually see the results. Because if we don't have that, then we are unable to even tell the leaders that we want accountability for 1, 2, 3 funds that you received. And we've seen a rise in taxation burdens, a lot of new taxes coming up just to increase the tax base, because now the country is too much indebted and there's no way to get more revenue. Then citizens end up there's no services, but you're paying too much taxes. So there's literally oppression. So I don't know if, my question maybe it is to Isabella, whether IMF and other such institutions can give sanctions or say, no, we are not giving you more debt because 1, you have not adequately accounted for this kind of debt that we've given you. Even just looking at the recent credit facility that was received from IMF, there's a lot of corruption around COVID-19 funds in Kenya. Then can you use that as a basis to say, because you have not been accountable on 1, 2, 3, or you have misappropriated 1, 2, 3 funds, then for us, we are cutting your funding, or we are no longer giving you more loans? Or what kind of mechanisms can, I see Julius is laughing, so what kind of mechanisms can IMF and other financing institutions put in place to, help us citizens, even civil society organization, outcry for prudent public debt management? Thank you.
So thanks, Irene. These are very important questions. I have to admit I'm not privy with the debt transparency data in Kenya. I know that the World Bank has a database where the countries have to commit to reporting or the debt stocks with rather high frequency. And I can perhaps take a look and we'll send you some links. But so what are the ways in which we make the information you're asking about transparent? So when we are typically dispersed to government in the context of a program, we issue a report in which you can see not only what are the current debt level, but what is the plan schedule of disbursements for the next few quarters. Let's talking at least for the 6 months ahead. And these disbursements are linked to conditionality, and this requirement typically encompass, some improvement in governance that can span from, revenue management to public investment management, procurement processes, governance, anti-money laundering. We also look at how central banks operate and whether they are equipped to channel our funds in an appropriate way. So, usually within the context of our program, there are a lot of safeguards around how the funds are being used. And the leverage we have is that, if they are not, followed, we can suspend our future disbursements within the context of the program. You have mentioned the funds that have been disbursed in the context of the RCFs in May. And there, this has been an exceptional financing to which we did not attach our, usual heavy loaded conditionality, but they were not necessarily without strings attached. And some of the requirements we have had under these programs is precisely the ones you're mentioning. To, account for the fact, first of all, to spend all the funds on COVID-19. To account for everything that was spent, to publish it. And even some countries have gone beyond that, and they have did an ex post audits of those funds. Some countries are lagging, and they're still trying to, implement frameworks that will allow them to track that expenditure. And I have to admit, this is a complex animal because countries have decided to use that money in very different ways. Some have, provided direct financing to the households, and some have provided financing through other means. Such, for instance, Uganda has opted to channel the funds through the development bank, and that is makes it more difficult for us to look at, at the level of, how to track that expenditure. And the IMF has actually provided technical assistance to Uganda to help them establish a framework that would allow to track these funds. And the next step would be to publish. We have also advised to publish the large procurement contracts, and this is something in the making. And we are hopeful that it will take place. That those publications will be available ahead of our forthcoming discussions on the fund program with Uganda.
Thank you so much, Isabella, for that response. And I think also as civil society, our work is cut out also in terms of tracking these resources. Because of time, I'm going to give each of our panelists just 1 minute for their parting shots. And I will start from below, from Julius. 1 minute, your parting shot, especially looking at the way forward.
Yeah, thank you, moderator, and thank you, panelists. Thank you, the viewers and listeners in. On access to information, there is certainly the Kenyan bit. There is certainly a lot of access to information now on the website of the different institutions. We could link up bilateral, and we are able to delve through that through the databases, and as Isabella has highlighted. But I think going forward, we will need more closer cooperation with IMF. Some of us have a bigger belief in the IMF compared to some of these other institutions, which also then gives you a bigger role in terms of expectation. Working closer so that we are able to delve into some of these bits in greater discussion. But I think there is also an opportunity in beginning in opening up and call for greater transparency with the COVID resources. Uganda received so far about 19 loans in respect to COVID response. Government needs to tell citizens how far are we, because these are the ones that are staked as collateral. Thank you.
Thank you so much, Julius. Alvin?
Yeah, two very short comments. I think in line with the title of this webinar, I think that we need to work towards turning away from the game of loans to game of taxes. That's really critical, and I think that's where the future lies. In terms of looking at development financing, yes, loans are going to play a critical role in the short term. We need to find ways of ensuring that those loans are not undermining our economic growth, but the future really lies in our ability to mobilize our own resources, and that will create the kind of social contract between citizens and the government, and move away from a situation where we are now moving and appealing to the IMF to put more conditionalities on our governments. I think that's where we should be. That's where the future lies. The contract is between the state and the citizens, and I mean, yeah, I'll stop there. I'll stop there for now.
Okay, thank you so much, Alvin. Isabella?
So just a few words to thank you for organizing this seminar. We have a very difficult agenda in front of us, and it is very important that we all work together, you know, the IMF, the government, the other development department, and the civil society organization. We value extremely these interactions that we have. We see the civil society as instrumental in, you know, evaluating the feasibility of government policies. We see them extremely important in shaping the IMF programs. I would advise the CSOs to engage in you know, the government and international bodies in the effort to improve that transparency and that architecture, and to advocate for the borrowed funds to be used for intended purposes and monitor the use. I think these two things are extremely important, but also to be mindful that the political processes sometimes take time to bring fruit. So this is what I want to leave you with.
Okay, thank you so much, Isabella, for those words of wisdom. Jason?
Yes, thanks. Just to echo everyone's appreciation, Jane, to SEATINI for pulling this together. I think Alvin stole my sheet because he said the two things I wanted to say, but maybe I'll maybe put a different spin on it. I think the first one is we can't borrow our way out of this pandemic. So I think, you know, loans to support loans and loans to support debt. I think this is just a cycle that's not going to end well for our region. And second, it is about stopping the bleeding because we are bleeding it from all corners. So those would be my two takeaways from today. Thank you.
Thank you so much, Jason. Leonard?
Thank you so much, Jane. And I'd also like to join the others in acknowledging and appreciating you hosting us to have this discussion today. I think for me, the one point in terms of getting to know what is really happening, one thing we can begin to do in the region is to champion that Parliament takes a more aggressive stance in asking questions about our debt, about our taxation, about its allocation, so that the inconsistencies that are actually glaring begin to get addressed, because it seems whether it is their position in this context, it's like they're in a place where they choose to see, hear, or speak no evil about the debt and the revenue challenges that you're seeing. Other than that, we just like to make a commitment that we'll continue trying to simplify the tax information and the tax debates that are coming about, just like we are trying to do with our presentation and our paper, so that we can get more people kind of speaking out on what is happening and how it affects their lives. Thank you.
Okay, thank you so much, our panelists. On behalf of the organizers, I would like to sincerely thank you so much. There's a lot of expertise, a lot of wisdom which has come from the panel, the panelists. Thank you so much. The issue of debt is a challenge to us, and there are so many proposals which have come on table, and I think we need to cooperate. We need to have our voices heard, but most important, we have to work together. The issue which Jason has raised, that we can't borrow our way out of this situation, is really true, and the issue is to be able to address our DRM. No? So thank you so much, our participants, thank you so much, and very sorry to go on and on, but it was such a wonderful discussion. Thank you so much, and please stay well. I wanted to point out that we have been supported by Diaconia to carry out this conversation, and we are really grateful to the constant support from Diaconia and Corporation. So thank you so much. Thank you. Thank you, Julius, Alvi, Isabella, Jason, Leonard, and bye-bye. Let us continue that.
Thank you, everyone. Bye-bye. Bye.
All right, have a good evening.
Bye. Good evening.